Now this topic feels very close to actual valuation practice, property tax and municipal levies, because this directly affects income, right? But I want to understand deeply how exactly these taxes connect with valuation.
Very good. This is one of the most practical topics. Property tax is not just a statutory payment. It is an ongoing cost that directly reduces income and therefore reduces property value. Let us go step by step.
So first, how is property tax calculated?
There are three main methods used by local authorities. This method is based on expected rental income.
So similar to income approach?
Yes, it assumes what rent the property can generate annually and tax is calculated on that. Here, tax is based on market value or government assessed value.
So if property value increases, tax increases?
Exactly. This method links tax directly to capital value. This is based on fixed rate per square foot or square meter multiplied by area.
So simpler and more transparent?
Yes, widely used in many cities. In some systems, property owners calculate and declare tax themselves based on rules.
So responsibility lies on owner?
Yes, but subject to verification.
So property tax is a recurring expense?
Correct. It is an annual outgoing and must always be considered in valuation.
Now this is critical. How does property tax affect NOI?
Let us understand clearly. Start with effective gross income. Deduct expenses including property tax. Result is net operating income.
So property tax directly reduces NOI?
Yes, and since valuation, especially income approach, is based on NOI, even a small increase in tax can significantly reduce value.
So tax affects the numerator in valuation formula?
Exactly.
So this deduction happens before valuation?
Yes, always calculate value based on net income, not gross income.
So two similar properties with different tax burdens will have different values?
Absolutely correct.
What if property tax is wrongly assessed?
Property owners have the right to appeal. If assessment is incorrect, if unfair or based on wrong data.
And where do valuers come in?
Valuers may be engaged to prepare independent reports, justify fair rental or market value.
So we act as technical experts in disputes?
Yes, very important professional role.
Now this is the core. How does this integrate with valuation methods?
Three key areas. Accurate NOI estimation is critical. Tax directly reduces income. Overestimating income leads to overvaluation. Different areas may have different tax systems. Must compare properties on net basis, not just price. Property tax affects cash flow, impacts long-term profitability.
So investor perspective is very important here?
Yes, investors always look at net returns after tax.
This TDS part, how is it relevant?
If property value exceeds rupees 50 lakhs, buyer must deduct 1% TDS. Also, rent above rupees 50,000 per month TDS applicable.
So this affects transaction compliance?
Yes, and also impacts cash flow timing.
So if I connect everything, property tax is a recurring cost, it reduces NOI, lower NOI means lower value, different tax methods affect valuation differently. Appeals and corrections are possible.
Excellent. Always remember, in income-based valuation, even small changes in expenses like property tax can create large changes in value.
So as a valuer, I must treat property tax not as a side factor, but as a core valuation input.